Welcome back. Today we're diving straight into an analysis report on Navitas Semiconductor. It's all about their big strategic pivot, what they're calling Navitas 2.0, targeting the AI data center and EV markets.
A huge transition. High risk, but potentially very high reward.
Exactly. And the analysis captures that tension well. But let's jump right into the first major area where it can be a lot stronger. We think the analysis needs to fully quantify the implications of the massive insider selling event, moving beyond treating it as a standalone red flag.
Yeah, I see exactly what you mean here. Section 4 does a good job of flagging this. Director Brian Long selling almost 1.5 million shares.
Which is something like 87% of his direct holdings. It's a huge signal.
A huge signal, right? And the report highlights it as a behavioral concern, a trust issue. But the weakness is that it's treated in isolation.
It's siloed.
It's silo, yeah. It doesn't explicitly connect that massive selling pressure back to the fundamental financial risks that were already laid out in the air pocket section.
So it's like a running theme here, the need to connect these behavioral signs directly to the quantitative model. I mean, when 1.5 million shares just hit the market,
That's real supply.
it's downward pressure, plain and simple.
Absolutely. And that volume has a quantifiable impact, especially for a stock that the report itself says is in this air pocket between $7 and $9. So the suggestion for improvement is that the analysis really has to integrate this insider activity into the financial risk model.
So not just a note, but an actual input.
Exactly. Assess how that amount of selling actually interacts with the price targets and, crucially, the revenue ramp timeline. It's a force multiplier on the existing risk.
And that makes perfect sense. If the analysis is saying that investors should wait for the price to stabilize above $8, well, this event is a critical variable in whether that can even happen.
It is. Which leads right to some concrete examples. First, the analysis should explicitly model how this selling pressure might delay that stabilization point. I mean, could this event, combined with the low Q4 guidance, push stabilization past the February 2026 earnings call?
That's a great question. Because if the technicals can't hold because of this supply, the whole thesis timing shifts.
The whole timeline gets thrown off. It changes the entry point completely.
It moves the discussion from why did he sell to what did the sale actually do to our timeline?
Precisely. And for the second point, we should use this insider sale to stress test the company's safety net. The report mentions the $150 million in cash, no debt, which is great.
A critical buffer.
But how long does that cash really last if the ramp gets delayed? The sale is almost like a signal for a worst-case scenario. So the analysis should run a specific model. What if the ramp is delayed 6 months?
Okay, so a stress test.
Yeah. Show how the cash burn is impacted and what specific revenue or, cost targets the company would need to hit to avoid falling toward those really skeptical valuation floors, like the Morgan Stanley 420 target.
Right. That transforms the red flag from just a warning into a functional part of the downside modeling. It gives the reader a real quantitative anchor for their risk tolerance.
It really strengthens the conviction level of the whole analysis by defining the exact conditions under which the floor could break.
Okay, let's move on to the strategic pivot itself, the bull case. Section 2A makes a strong case for the key win with NVIDIA's 800-volt DC power architecture. But to really maximize the impact here, the analysis must more explicitly connect the technical superiority of gallium nitride and silicon carbide to the competitive advantage in the AI data center segment.
That's a great point. The material does a good job explaining the tech generally. AI chips are power hungry. Traditional silicon is inefficient, it creates heat.
Wastes energy, needs huge cooling systems. We get it. And GaN and SiC, these wide-band gap semiconductors, they solve this. High voltage switching, less loss, smaller size.
The argument is all there conceptually, yes. But the weakness is that the differentiation it's more conceptual than competitive. The $2.6 billion opportunity is mentioned, but the argument for Navitas' specific moat feels a bit thin.
And using GaN and SiC isn't proprietary to Navitas. So why them? Why is Navitas the one positioned to actually capture this? And does that support the huge revenue ramp they're expecting in late 2026 and 2027?
Is there a risk that by focusing only on the tech benefits, the analysis might be overlooking the execution risk? Or, the chance that incumbents with deep pockets could catch up? We need tactical proof.
Exactly. So the suggestion for improvement is to bolster the argument, give us the context for why Navitas' solution is positioned to beat the big, established players in this specific 800V application. That's what will cement the logic for that revenue ramp.
And building on that, let's offer a couple of actionable ways to do it. First, briefly frame the competitive landscape. Who else is out there?
Other power management firms, other GaN startups?
Right. Who's tackling this need in AI factories? And maybe most importantly for this kind of analysis, how does that confirmed key win with NVIDIA, a company that is famously rigorous with its suppliers, how does that win specifically show Navitas' advantage over the competition?
Because that NVIDIA validation is the core of the moat.
It is. If the analysis can really show that Navitas didn't just win a contract, but that they won a competitive battle against known, high-volume players for a mission-critical application, the credibility of the whole thesis just skyrockets.
That's the difference between saying the technology is good and proving this specific company is leading the adoption.
That's it. And second, we need a clear, brief comparative metric. Give the reader a tangible benchmark. Quantify the efficiency gains. For example, how much smaller is the power supply? Or how much does it reduce system-level heat when you use Navitas GaNSafe or GeneSiC products over traditional silicon in a server rack?
Quantifying it makes the technical need real for an investor. If GaN allows for a 40% smaller power supply, that directly means fewer racks for cooling, which saves millions in capex for the data center builders.
Exactly. It connects the necessity of the 800V architecture directly to Navitas' specific products. It stops being a vague technical pitch and becomes an essential piece of next-gen infrastructure.
Okay, so our final high-level critique. This one focuses on the deep skepticism in the market. The report points out the divided analyst consensus, from Needham's optimistic $13 buy all the way down to Morgan Stanley's $4.20 sell.
That's a huge range.
It's massive, and given that division, the analysis needs to sharpen its counter-arguments against the most bearish thesis, particularly concerning the timeline of that 2026 revenue ramp.
The bear case in the conclusion mentions the general risk, right? Revenue declines if the ramp is delayed, cash dwindling. But the weakness is that the report doesn't really deconstruct the assumptions that are driving that extreme low price target, that 420 number.
It just sort of presents it as a fact.
Yeah, and if you're positioning this as a watch list stock for aggressive investors, you have to arm them. They need to understand and be able to defend against the strongest possible counterargument. You have to define the point of failure.
That makes sense. The analysis has to show that the current thesis has already stress-tested the most damaging alternative views.
Right. So the suggestion for improvement is to systematically address that main bearish concern, the risk of a ramp delay. Do that by defining some actionable non-revenue milestones and using that skeptical 420 valuation as a foil to defend the current thesis.
That's how you build conviction. Investors can't wait 18 months for the revenue numbers to confirm everything. They need early signs of success.
They need leading indicators. So to start, define 2 or 3 critical, non-revenue milestones beyond just hitting the Q4 $7 million bottom line that investors should look for in early to mid-2026.
And what might those look like? Things outside of the quarterly reports.
Exactly. It could be specific high-volume manufacturing qualification announcements with other Tier 1 partners, or securing more high-profile design wins in the EV space.
So de-risking the timeline by showing it's not all dependent on the AI data center story.
Yes, it proves they're executing across both pillars of the Navitas 2.0 strategy. These milestones show broad execution is happening.
And identifying those early operational wins helps solidify the transition story long before the financials prove it. It shows they can secure future business, not just manage current results.
And second, let's directly use that Morgan Stanley 420 target to illustrate the worst-case scenario. Outline what fundamental assumptions about the AI boom or the 2026 ramp would have to truly fail, not just slow down, but utterly collapse for the valuation to actually hit that level.
So what has to go catastrophically wrong? Does the NVIDIA deal have to be terminated? Does GaN adoption in EVs have to grind to a complete halt?
Exactly. Frame it that way.
That's a powerful framework. By defining the catastrophic failure point, the report really strengthens the conviction behind its watch list verdict. The reader can then clearly decide if their own risk tolerance can handle that worst-case scenario.
It reframes the risk from some vague fear into measurable outcomes. It shows the reader that those low price targets aren't just analyst pessimism. They're based on specific, quantifiable failure assumptions.
This has been a really insightful look at how to maximize the impact of this Navitas Semiconductor analysis report. We've tried to focus on the high-level leverage points that will make it essential reading for aggressive growth investors.
Yeah, we centered on three main opportunities. First, better integrating that huge insider selling risk into the financial models as a real quantifiable headwind.
Then, deepening the competitive moat of the GAN and SIC tech by adding specific metrics and competitive context.
And finally, sharpening the counterargument against those really bearish valuation targets by defining actionable, forward-looking milestones.